Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Going back to in, at, and out of the money options, in the money have the highest probability. That does not make them the best options to buy. It does mean that they have the highest probability of remaining in the money, but they're also the most costly. In the money, most costly. At the money options are sort of balance in between. So I call it a balance, so equal between the out of the money and the in the money. Because, again, they're in between, and the out of the money options offer what I call L, the most leverage. All options have some leverage, but the out of the money options have the most leverage. And you, and only you, can determine which options make the most sense. If I thought the market was going to make a small move, and I wanted to trade in the options market, I might be trading, if I'm a buyer, an in-the-money option. If I thought it might make a moderate move, I might be buying an at-the-money. And if I thought it was going to make a big move, I would probably be buying an out-of-the-money option. So there is a scenario for every different strike price category. But again, it really depends on what you think the risk-reward, how it's shaping up, versus your view and the market's view. So here's a screenshot. This is actually taken a year ago when dollar-yen was trading at 100. Now, if we knew then what was going to happen today, what would we have done? I'm just going to take I'm going to offer this to the audience. Right? If you see, dollar-yen was trading 124 in 07, 108 in 2008, and around parity or around 100, if you will, in 2009. And if I knew then, where it was going to be trading now, what would have been a better option to buy, a put or a call in general? So I'm just trying to see if you guys are getting this stuff, right? If we knew that dollar-yen was going to be where it's trading today, I think we all know that it's has significantly changed from that 100 level. Which would have been better to buy? The 100 call or the 100 put? Thank you. Thank you. The answer is a put, right? Because you would have had the right to sell the U.S. dollar, and that dollar has declined in value versus the Japanese yen. So in general, puts would have been the better one to buy back in 09. You could have been buying 9-month options. Obviously, you could have been buying 1-month options. But looking at dollar-yen, now that we're significantly lower from the 100 level, puts would have been better. So let's go through some examples with dollar-yen way back at 100. But this just helps. We know that it's much lower today. But if the exchange rate is 100, the 90 calls are in the money, the 90 puts are out of the money, the 100s are at the money, calls and puts. The 110s are out of the money, calls, but they're in the money for the puts. So you'll notice it's sort of this relationship where the 90 calls and the 110 puts are in the money, and the out of the money options are the 90 puts and the 110 calls. And the 100s are at the strike. I hope that makes sense to everyone. And here are the quotes. 1-month options. So the way back when the calls were trading for about $2, the puts were trading for $1.65, and in general, all these puts probably gained in value, considering that the dollar-yen value went much, much lower, depending on the expiration month. Right? So calls had these values, and you could have been a seller of those. You might even done some call spreads, and that's what trading the options is about: is what might happen in the future. Is the risk worth the reward? So nothing more important than risk-reward. If you don't have a view, you probably don't want to be trading, but if you do have a view that's much different than what the market's offering versus the risk-reward, then it's an opportunity. Always think in terms of your own goals and your own risk tolerances. Options allow for either increasing or decreasing of risk. You can decide that. And again, there are many different option strategies, whether you're a hedger, whether you like to bring in income, or if you're someone that's just trying to implement a price forecast with a limited risk. So option premiums, intrinsic value plus extrinsic value equals your total option premium. Out of the money options contain all extrinsic value, and the money options have intrinsic value. The amount of intrinsic is depending on how deep in the money it is. So if I had an asset that was trading at 108 and I had bought the 100 call, well, the intrinsic value would be 8. That doesn't mean that it might not even be trading for more than that 8, because there might be a little bit of extrinsic value left in it, and maybe even more than a little bit if there's plenty of time left until expiration, many months. At the money options have all extrinsic value, but they have the ability to turn into intrinsic value pretty quickly. So just to reiterate, what are these options? They give the buyer the right to buy or sell an asset. Again, today we're talking about currency pairs at the strike price for a certain period of time. The buyer pays that premium. How about for sellers? Well, sellers have the obligation, but not the guarantee, to buy or sell that exchange rate at the strike price for a certain period of time. And that obligation, for that obligation, the seller receives an option premium from the buyer. Buyers have different motives than sellers. If I'm looking at a lot of the ISEFX options, they're dollar-based. We do have some dollar quote options, though, just so you're aware of that. For example, the euro, the British pound, the Australian dollar, the New Zealand dollar, we do have dollar quote. But a lot of them, for example, the dollar against the yen or a dollar against the Canadian dollar, they're dollar-based. So you'd have to think in those terms. Another view could be that the call buyer is hedging another currency by purchasing call options. That's very possible. Put buyers are generally bearish on the dollar if you're trading that dollar-based product. You could also be hedging, and again, you're limiting your risk. Sellers have different motives. Sellers are looking to take in income, depending on which currency pairs you're trading. A seller of a call, if it's, let's say, dollar-based, you'd be bearish on the dollar. But it would be the reverse if you're trading the dollar quote. So just to reiterate, it's really important to think in terms of what is the base currency. If the dollar is the base currency, if you're bullish on the dollar, you'd be buying calls or selling puts. If you're bearish on the base currency, you'd be buying puts or selling calls. So think of it in those terms. Sellers of options take a lot more risk than buyers because they can lose a lot more. Now, it doesn't mean that sellers have an inferior strategy because they're going to win more often. More than likely, if the market stays unchanged, the seller is going to earn a profit relative to the buyer. But the buyer has the ability to earn a lot greater multiples on their money because they have limited risk. So that's very important. That's a key point to the options market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.